In the autumn of 1998, the Federal Reserve Bank of New York convened an emergency meeting that changed the history of financial regulation. The heads of the 14 largest financial institutions in the United States were called to a conference room in Lower Manhattan and told, in terms that left no room for interpretation, that they needed to collectively inject $3.6 billion into a failing hedge fund. The alternative, as the Fed explained it, was a cascading series of defaults that could paralyze the global financial system. The banks agreed. The bailout was executed over a single weekend, and the world never fully understood how close it had come. The fund was called Long-Term Capital Management. Its founders included 2 Nobel Prize winners in economics, a former vice chairman of the Federal Reserve, and a collection of mathematicians and financial theorists who were, by almost any measure, the most intellectually formidable group ever assembled to trade financial instruments. They had built a mathematical model that had generated extraordinary returns for 4 consecutive years. From its founding in 1994 through early 1998, LTCM had never had a losing quarter. It had made its founders and investors spectacularly wealthy, and it had persuaded virtually every major bank on Wall Street to lend it money on terms that, in retrospect, bordered on the criminally negligent. In the summer of 1998, the model failed. Not partially, completely. In 4 months, long-term capital management lost $4.6 billion. Its capital was effectively wiped out, and the size of its positions was so enormous that an unmanaged collapse would have forced it to dump assets into markets that had no capacity to absorb them, triggering margin calls at every major bank that had lent to LTCM, which would trigger further selling, which would trigger more margin calls. Federal Reserve officials assessed the likely consequence as potentially the worst financial crisis since the Great Depression. John Meriwether was born in 1947 on the south side of Chicago. He joined Salomon Brothers in 1973 and built their arbitrage group into the most profitable trading desk on Wall Street, recruiting academic economists and mathematicians to trade alongside experienced practitioners in a culture that was simultaneously rigorous and aggressive. In 1991, a member of his group submitted false bids in U.S. Treasury auctions. Meriwether had been informed but had not reported the violations promptly. He was fined and forced to resign. He spent 2 years in professional limbo. Then, in 1993, he began assembling a new team. The 2 men he recruited, who would later win the Nobel Prize, were Robert Merton and Myron Scholes. Together with Fisher Black, Scholes had developed the Black-Scholes formula, one of the most important equations in the history of finance, a method for calculating the theoretical fair price of options contracts. The formula assumed that financial markets behaved according to certain mathematical laws, that price movements were random in quantifiable ways, that extreme events were rare, that markets were liquid enough that positions could always be exited near their theoretical value. These assumptions were excellent approximations of how markets behaved most of the time. The problem was what happened when they failed. LTCM raised $1.3 billion in initial capital in 1994, the largest hedge fund launch in history. The fund returned 28% in its first year, 59% in its second, 57% in its third. By early 1998, it had $125 billion in assets and had taken positions in derivatives contracts with a notional value of approximately $1 trillion, achieved through massive leverage. Its equity capital was $4.7 billion. Against that equity, it had borrowed and positioned $125 billion. The leverage ratio was 25-1. If the assets lost 4% of their value, the equity was gone. In August of 1998, Russia defaulted on its government debt. The default triggered a global flight to safety, investors moving simultaneously out of riskier assets and into U.S. Treasury bonds. This movement compressed the price differences between safe and risky assets in ways that were correlated across every market in which LTCM operated simultaneously. The fund's positions had been built on the assumption that these price differences would converge. Under the pressure of the Russia crisis, they diverged. The models had not assigned significant probability to this scenario. The models had assumed that different markets were not perfectly correlated. When fear spread globally, that assumption failed everywhere at once. LTCM began losing money at a rate that its models classified as essentially impossible. Events that were supposed to occur once in several billion years of market history were occurring every single day. In September of 1998, the partners sought outside investment to stabilize the fund. Warren Buffett made an offer, $250 million for the fund's equity, with the existing partners to be immediately removed from management. The partners declined. The offer expired. 3 days later, the Federal Reserve organized the consortium of 14 banks. The bailout was executed. The fund was unwound over the following year. The global financial system did not collapse. What LTCM's failure demonstrated was not that mathematical finance was wrong. It demonstrated something more specific. It demonstrated that the risk of extreme events had been systematically underestimated by every major financial model in use. In extreme conditions, markets did not behave according to the assumed distribution, and the presence of a fund as large as LTCM in the market meant that its failure would itself create the kind of extreme conditions that its own models had not anticipated. The fund was not merely betting on markets. It had become a component of the markets it was betting on. Its failure accelerated its own failure. Robert Merton and Myron Scholes received their Nobel Prizes in October of 1997. 1 year before the fund, they helped build, nearly collapsed the global financial system. The regulatory consequences were significant. The LTCM crisis introduced the concept of systemic risk oversight and too big to fail into formal government documents, frameworks that would define the response to the 2008 financial crisis a decade later. Meriwether subsequently founded 2 more hedge funds. Both ran into difficulties. The banks that participated in the bailout recovered their investment. The investors in LTCM lost most of their capital. And the question that LTCM raised, whether sufficiently large concentrations of mathematical certainty can themselves become systemic threats, has never been fully answered. Subscribe to The Reckoning